You have been making your student loan payment every single month since repayment started. You have not missed once. But when you log in and check the balance, the number barely looks different from where it was 6 months ago. You pull up the payment history, and there it is. Most of what you have been sending is going to interest first, and only a thin slice actually touches the principal. It feels like running on a treadmill, where the belt speeds up every time you start making progress. That is not a glitch, and it is not random. Federal student loans usually accrue interest daily, meaning the balance grows a little every single day between payments. And when your payment finally lands, it does not go straight to the debt itself. It hits fees first, then accrued interest, and only after those are covered does anything reach the principal. That payment order is the reason so many people feel stuck, even when they are doing everything right. If enough interest piles up between payments, or if unpaid interest gets added to the balance through capitalization, the hole can feel like it is getting deeper instead of shallower. I am Sam from Simply Money, and I have spent an unhealthy amount of time studying why student loan math confuses borrowers who are genuinely trying to pay down their debt. If you have ever looked at your balance after months of payments and felt like the number should be lower than it is, subscribe, because this channel is built to make that kind of financial confusion finally makes sense. Today, I am going to break down the 4 mechanics that control how your student loan balance actually moves: daily interest accrual, the payment waterfall, capitalization, and the one extra payment trick that changes where your money actually lands. Let me start with the part of the system that runs every day, whether you are paying attention or not. Federal student loans usually accrue interest every single day. The loan takes your outstanding principal, multiplies it by the daily interest rate, and adds that amount to what you owe in interest. It does not wait for the end of the month. It does not pause on weekends. It runs whether you are making payments or not, and it starts the moment the loan is dispersed for unsubsidized loans. For subsidized loans, the government covers that daily charge while you are in school and during grace. But for unsubsidized borrowers, interest begins building from day one. That difference matters more than most people realize. 2 students can borrow the same amount at the same rate, but the unsubsidized balance starts growing much sooner. Picture a recent graduate who took out $30,000 in unsubsidized loans at 6% and made no payments during school or the 6-month grace period. By the time the first bill arrives, interest has been building for roughly 4.5 years, at a daily rate of about $4.93. That adds up to more than $8,000 of accrued interest sitting on top of the original balance before a single payment is even due. The borrower logs in, sees a number above $38,000, and feels like the system already cheated them. But what actually happened is simple math running on a clock that started earlier than they expected. Now here's the important correction. The scary part is not daily compounding. Most federal student loans use simple interest, meaning the daily charge is calculated off the principal you still owe, not off previously accrued interest. Interest does not automatically turn into new principal every day. That distinction matters because it means the daily growth rate stays anchored to the original balance as long as no capitalization event happens. The system is not spiraling on its own. It is accumulating, and the accumulation only becomes structurally worse when a specific trigger converts that pile of unpaid interest into new principal. Capitalization is that trigger, and it is event-driven, not continuous. It typically happens when you leave a grace period, exit deferment, or forbearance, or in some cases, when you leave certain repayment plans. At that moment, all the interest that built up during the non-payment period gets added to the principal balance. Now the daily interest formula starts calculating off a larger number. Go back to the graduate who owed $30,000 and accumulated $8,000 in interest. If that interest capitalizes, the new principal becomes $38,000, and the daily interest charge jumps from about $4.93 to roughly $6.25. That is an extra $32 every single day, which over a full year adds almost $500 of additional interest that would not have existed if capitalization had not happened. That is where the feeling of falling behind gets structurally real. It is not magic, and it is not a scam. But it is a mechanism that most borrowers do not see until after it has already changed the math. This brings us to the part that explains the opening. When your payment lands, principal is last in line. The servicer applies your money first to any outstanding fees, then to all the accrued interest, and only after those layers are fully covered does anything go toward reducing the principal. So if you owe $30,000 and $500 of interest has built up since your last payment, and your monthly payment is $350, every cent of that payment goes to interest and fees. Zero reaches principal. The balance does not move. That is not a broken system. It is the payment waterfall working exactly as designed. But it creates a situation where a borrower can be making every scheduled payment on time and still feel stuck because the visible number barely changes. Nearly 2/3 of borrowers in the CFPB's survey said repayment had been hard at some point, and roughly 1 in 5 borrowers with outstanding loans were already behind or in collections by late 2024. The frustration is real, it is widespread, and it is often rooted in this waterfall mechanism that nobody explained clearly at signing. Now here is the turn that changes what the viewer does next. Most people assume that if they pay more than the minimum, the extra automatically attacks the principal. That is not always what happens. Some servicers will take that extra money and place your loan in paid-ahead status, meaning they apply it toward next month's bill instead of reducing the principal right now. The same extra $50 or $100 can do two very different things depending on how the servicer processes it. Directing the excess to principal reduces your total payoff cost faster because it lowers the number that the daily interest formula is running on. Letting the servicer use it for paid-ahead status just moves your next due date forward without changing the underlying math at all. Here's a quick comparison to make the difference concrete. Say you have $25,000 in principal at 6%, and you send an extra $100 every month for 2 years. If that $100 goes to principal each time, you shave the daily interest base down faster, which means less interest accrues between payments, which means more of your regular payment starts reaching principal too. The effect compounds over time, even though the loan itself is simple interest. But if that same $100 goes to paid-ahead status instead, your principal stays the same size, the daily interest charge stays the same, and you have simply prepaid bills that were coming anyway. Same money, same borrower, very different outcome depending on one setting in your servicer's system. The CFPB specifically flags this distinction and recommends that borrowers contact their servicer to make sure extra payments are applied to principal, not used to advance the due date. That one instruction applied consistently can change the entire trajectory of a loan without requiring any additional money. So, what do you actually do with these four mechanics? The answer depends a little on where you are right now. If you are still in school or in a grace period on unsubsidized loans and you can afford even small payments toward the accruing interest, that prevents a larger capitalization event later. Even $50 a month during grace can reduce the interest pile that would otherwise get added to your principal when repayment begins. If you are early in repayment and your balance barely seems to move, check whether your minimum payment is large enough to cover all the accrued interest each month. If it is not, your principal will not shrink until the interest layer is cleared first. If you're already making payments and have a little extra each month, call your servicer or check your online account settings to confirm that overpayments go to principal, not to paid-ahead status. And if you are on a repayment plan you did not actively choose, know that about 1/3 of borrowers on the standard plan said they did not even know other options existed. You may have more flexibility than you think. The decision rule is this: every dollar you send toward a student loan passes through the same waterfall. Fees, then interest, then principal. You cannot skip the line, but you can shorten it. Paying consistently keeps the interest layer from growing out of control. Paying a little extra, directed to principal, compresses the timeline by shrinking the number the daily formula runs on. And understanding capitalization events lets you see the moments where the math changes permanently so you can act before they happen instead of reacting after. Your student loan balance is not a mystery, and the fact that it moves slowly is not proof that you are doing something wrong. It is proof that the payment waterfall is doing its job in an order that was never designed to feel satisfying. Once you see the waterfall, you stop wondering why the number will not move, and you start directing your money to the layer that actually changes it. In the next video, I want to walk through exactly how to read a student loan statement so you can see the waterfall on paper and know where every dollar actually landed.